Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at USO.
If you find our talks useful, please consider subscribe, like, and comment underneath. So imagine buying an asset that is currently up over 25% in just 3 months.
Right.
And it's tracking literally the most vital commodity on the planet. But, and here's the crazy part, if you hold it in your portfolio for 10 years, you are mathematically guaranteed to lose money.
Yeah, it's a massive paradox.
It really is. And that's exactly what we are untangling today. We are looking at the United States Oil Fund, which is ticker USO. Right now, it's sitting at this massive 8 out of 10 bullish thesis score.
Which is a score that definitely demands attention.
Exactly. But we have a very specific mission for you today. We're going to explore the fundamental mechanics of how this fund actually operates. Because, honestly, treating it like a normal stock is just a recipe for disaster.
Oh, absolutely.
And then we'll look at the geopolitical shocks that are sending it into this breakout territory right now, dig into the hidden mathematical risks of futures trading, and finally, map out why the market views this strictly as a 1 to 3 month swing trade, not a buy and hold.
Right, because if you're sitting at home and you see that 8 out of 10 bullish score, you might be tempted to just put this in your retirement account and forget about it.
Which would be a huge mistake.
Do not do that.
Yeah.
Before we even touch the geopolitical news or the price surges, we really have to rebuild your understanding of what an asset can actually be.
Okay. How so?
Well, when you analyze a standard company, you're looking for revenue trajectories, profit margins, quarterly earnings reports. You have to throw all of that out the window here.
All of it.
Yeah, all of it. This fund does not generate traditional earnings. There is no corporate office selling a product anywhere. Its entire purpose is just to track the daily percentage changes in light sweet crude oil futures. Specifically, it tracks the benchmark oil futures contract on the NYMEX that is physically delivered to Cushing, Oklahoma.
Okay, let me stop you right there because we really need to explain this simply for you. If there's no company, no product, no free cash flow, what is actually sitting on the balance sheet? Like, what are you actually owning when you buy USO?
You are owning a piece of a commodity pool limited partnership.
A commodity pool?
Exactly.
Yeah.
And because there are no traditional operations, the financial health looks completely unique. I mean, it carries zero debt.
Wow, zero.
None. Instead, the fund is collateralized entirely by cash equivalents, and U.S. government obligations that have maturities of 2 years or less.
Okay, so let me make sure I'm getting this. It is essentially just a giant mountain of cash and short-term treasury bills sitting in a vault.
Right.
And they use that as collateral to buy paper contracts that basically say, I promise to buy oil at this price next month.
That is exactly what it is.
Which means there are no shareholder returns. I mean, no dividends, no stock buybacks. It's like buying a mirror, basically.
A mirror is a great way to think about it.
Yeah. You aren't buying the oil rig. You aren't buying the refinery. You are buying a mirror that perfectly reflects the price of near-term oil.
But hold on. If this is literally just a mirror tracking NYMEX futures, why wouldn't an investor just go out and trade the futures contracts themselves?
Right.
Like, why pay a fund to do it for you?
Well, let's walk through what happens if you actually try to trade crude oil futures yourself. First of all, you're dealing with massive margin requirements, and you need specialized brokerage accounts.
Which most people don't have.
Exactly. But more importantly, you have to remember that futures contracts are legally binding agreements to buy a physical commodity.
Right.
So if you make a mistake and you hold a contract until expiration, you are legally on the hook to take physical delivery of thousands of barrels of crude oil at a facility in Cushing.
Oh, wow. So you literally have oil showing up. Yeah. Unless you have a fleet of tanker trucks and a giant storage facility in your backyard, that is a catastrophic problem for a retail investor.
Okay, so the fund basically strips away the logistical nightmare of accidental physical delivery.
Exactly.
That makes total sense.
But it goes beyond just convenience, too. USO has a massive competitive moat, which is its first mover status. I mean, it was launched all the way back in 2006. It was the original oil ETF.
Oh, 2006, so it's been around.
Yeah, nearly 2 decades.
Yeah.
And over that time, it's built up incredible liquidity on the NYSE Arca exchange.
Okay, let's unpack that liquidity for a second, because the mechanics of how this fund actually maintains its size and its pricing accuracy are fascinating. We should talk about creation and redemption baskets. This is where the real institutional plumbing happens.
Yeah, it's cool. So think of the fund as an exclusive club. And the bouncers at the door are called authorized participants, or APs.
Views.
Right. These are massive institutional players. When demand for USO goes up, these APs bundle up the underlying assets, the cash in the futures contracts, and they hand them over to the fund.
Okay.
And in exchange, the fund hands the AP a creation basket, which consists of exactly 100,000 shares of the ETF.
100,000 shares at a time.
Exactly. Then the AP takes those shares and sells them to the public on the open market. And here's the kicker. They only pay a flat $350 fee per order for the privilege of making that swap.
Wait, just $350 for a basket of 100,000 shares?
Yep, a flat fee.
That is incredibly cheap for institutional scale. So the APs are essentially the pressure valve for the fund.
Yes.
If everyone is buying USO and the price starts to drift too high above the actual price of oil, the APs just step in, create hundreds of thousands of new shares, flood the market, and bring the price perfectly back into alignment.
That is the exact mechanism.
Here.
And to maintain that perfect mirror effect that you mentioned earlier, the fund uses a systematic near-month roll strategy.
Right, the roll.
Yeah. Every single month, over a very specific 5-day window, they sell their expiring futures contracts and buy the new contracts for the following month.
Okay, but why that specific 5-day window? Because I know there are competing ETFs out there that use like a laddered strategy. How does USO's approach beat the ladder?
Well, a laddered ETF takes your money and spreads it out. So it's across contracts expiring in 2 months, 3 months, 6 months, maybe even a year out.
Okay.
But that dulls the impact. If a major news event happens today, the 6-month contract barely moves.
Right, because the market assumes the crisis will be over by then.
Exactly. By focusing strictly on the near-month contract and rolling it over a tight 5-day window, USO captures the immediate violent price action of today's news.
Makes sense.
Their stated goal is to keep their net asset value, their NAV changes, within plus or minus 10% of the benchmark over 30-day periods. And historically, they hit that target with incredible accuracy.
And because USO is such a highly accurate mirror of the near-month contract, it's going to be hypersensitive to global supply chain disruptions.
Oh, terrible.
It doesn't care about what oil might cost next year. It only cares about the panic happening right this second. And I think that brings us to the explosive context that's driving this 8 out of 10 bullish score, because the mirror is reflecting some serious chaos right now.
It really is. We are looking at severe geopolitical tensions that have pushed Brent crude to hold stubbornly above $100 per barrel.
Right. And just to clearly lay out the facts for you on what is happening globally right now, there is extreme volatility in the shipping lanes.
Yes.
Particularly in the Strait of Hormuz, we are seeing major impacts from ongoing Iran strikes and the recent U.S. strikes on Karg Island. And we are looking purely at the mechanics of how these military events affect the global oil supply chain. We aren't taking sides, just looking at the facts.
Exactly. And the fact is, every time a headline hits about those events, the market reaction is swift and violent. The market is entirely focused on the risk to physical supply.
Right.
But here's the crucial piece of context that I think a lot of casual observers miss. This geopolitical premium is compounding with a baseline deficit.
Oh, the production numbers.
Yes. If you look at the data, November world oil production actually slid downward. The global supply was already tightening before the worst of these military strikes even happened.
Wow, okay.
So you have this fragile, tightening baseline that is suddenly being subjected to massive geopolitical shocks.
It feels like the global oil supply chain is acting like a tightly wound spring right now. Because production was already sliding, the market basically has zero shock absorption left.
None.
So any geopolitical attack, like the recent tanker attacks, just causes prices to violently gap up. You're seeing elevated volume driven entirely by these military moves and just sustained, relentless buying pressure.
And look at the performance metrics that spring has generated. The short-term trajectory for USO is just staggering. We are looking at a fund that is up 25.31% over the last 3 months.
25.31%. That is massive for a commodity ETF.
It is. In the context of its entire category, that ranks at number 4 out of 62.
Wow.
It's up 2.53% over the last month alone. And the year-to-date growth is sitting at positive 5.64%. The technical structures on the charts are printing very clear higher highs.
But you know what fascinates me even more than the charts? It's the rhetoric coming from the industry itself. You have oil CEOs actively warning about, quote, unpriced supply shocks.
Yep.
That is a very specific, very heavy phrase to use. I mean, if the asset is already up 25%, what does unpriced actually mean in this context?
Well, when industry executives say a shock is unpriced, they're arguing that the futures market, despite this massive rally, has still only calculated a moderate disruption.
Yeah.
They're suggesting the algorithms, the institutional models, haven't fully priced in a true worst-case scenario, like a total sustained blockade of major infrastructure.
Right.
And that kind of language turns what might normally be just a neutral news day into intense, upward bullish momentum, because suddenly the market is terrified it isn't bullish enough.
So the technical price action tells us what the market is doing right now. But the sentiment and the speculative catalysts from the CEOs tell us where the market thinks we are going next.
Exactly.
And the quantitative sentiment scoring is wild right now. The top 5 market stories are heavily, almost exclusively focused on oil.
Yeah, if you look at the raw ticker scores, the day-to-day fluctuations might occasionally appear neutral, but the underlying mood has fundamentally pivoted to firmly bullish. And it's based entirely on those supply risks.
Right.
The fact that Brent is holding above $100 due to the Iran tensions, the market sees that as a bullish pivot. The CEO warnings,
Yeah.
bullish.
Right.
The energy shock volatility and that November world production slide.
Yeah.
The entire narrative has just pivoted to a bullish outlook on severe market tightness.
Which means we really need to address the unconfirmed speculative rumor that is driving all the whispers behind this sentiment pivot. Because the market is buzzing about a Hormuz four-act crisis.
Yes, the four-act crisis rumor.
There are rumors of potential reruns of Strait closures. And the prevailing theory out there is that these subsequent acts of the crisis are currently entirely unpriced into the futures. Meaning, this massive 25% breakout we've seen over the last 3 months, that might just be the market's reaction to Act 1.
Right.
But let me challenge that narrative for a second. With all these rumors of a four-act crisis, are investors just panic buying the headlines? Like, is this just market paranoia, or is there a genuine structural reality backing this up?
It's absolutely a combination of both. But the foundation is structural. The headlines and the rumors about a four-act crisis, those are what drive the daily volatility and the sudden gap-ups.
Right.
But that underlying reality that we keep returning to, that November world production slide, that creates a legitimate mathematical foundation for the panic. The sentiment is heavily skewed towards supply disruption fears, sure. But those fears are anchored in a reality where the world is actually just pumping less oil.
Okay, so if I want to see if the smart money actually believes this four-act crisis rumor, how do I track that? Because normally, I would look for corporate insiders buying up their own stock, like Form 4 filings or 13F cluster buying from hedge funds.
Right.
But as we established earlier, this isn't a normal company. There's no CEO to buy the stock. So where is the footprint of the smart money?
You have to look at the authorized participants we talked about earlier.
The APs.
Exactly. Remember those creation and redemption flows. The APs who handle those 100,000 share baskets, they leave a data trail.
Okay.
When APs are creating far more shares than they are redeeming, it means massive institutional money is demanding access to this fund. And right now, that FLIR data shows clear, aggressive accumulation.
Wow.
Yeah, the smart money is definitely positioning for further supply shocks.
Okay, let's take a breath and just look at the whole board here. We have an 8 out of 10 bullish score. We have a barrage of unpriced speculative catalysts, a tightly wound supply chain with production actually sliding, institutional accumulation, and top-tier performance rankings.
It sounds perfect.
It does. The natural human instinct is to buy this fund, put it in a drawer, and just hold it forever to ride out the geopolitical storm.
And doing that will utterly destroy your capital.
Let's get into why.
Yeah, this brings us to the bear case and the fundamental risk assessment of how futures actually work. Buying and holding USO long-term is incredibly dangerous.
We really need to break down the mechanics of why that is, because this is the single most crucial concept for anyone looking at USO. It comes down to a mathematical trap called contango erosion.
Yes, contango.
Remember that systematic near-month roll strategy we discussed? Every month, over that 5-day window, the fund has to sell its expiring contracts and buy the new ones for the next month.
Right. Let's look at the pricing environment during that roll. If the future prices of oil are higher than the current spot prices, which is a market condition known as contango, the fund is forced to sell cheaper expiring contracts to buy more expensive future contracts.
Oh, wow. So they are basically forced to sell low and buy high.
Every single month. It is a structural bleed. The fund slowly loses value through that rolling process, regardless of what the actual price of physical oil is doing on the news.
Wait, so even if oil prices are flat, the fund loses money?
Exactly. To give you the hard data on what that decay actually looks like over a 10-year period, this fund's return is actually negative 4.42%.
Negative 4.42% after a decade. That is brutal. Let's visualize contango for you because it can be kind of a dense concept. Holding this fund long-term during a contango market is exactly like walking up a down escalator.
I love that analogy.
Yeah, you are constantly expending energy, basically paying a monthly roll tax just to stay in the exact same place. Right now, the geopolitical spring is giving the market incredible momentum. The market is basically sprinting up the escalator so fast that it's beating the downward pull.
Which is how you get a 25% gain in 3 months.
Exactly. But what happens if you stop sprinting? The escalator doesn't stop, it just drags you straight down to the basement, which is that negative 10-year return.
Yeah, the momentum is absolutely outrunning the escalator right now. And just to cover all our bases, the flip side of contango is called backwardation.
Right.
That's where future prices are actually lower. When that happens, the roll yield becomes positive. And you're basically walking down a down escalator getting a boost.
Which sounds great.
It is.
Yeah.
But you can never rely on backwardation lasting forever. The primary takeaway is that the current short-term bull market and these massive geopolitical premiums are basically acting as a shield against that baseline decay right now.
But relying on a geopolitical premium introduces the second major risk, which is sudden de-escalation.
Right.
The current bullishness, the sprinting up the escalator, relies heavily on the fact that Brent is clinging to that $100 mark strictly due to the conflict in the Middle East.
And if you take that a step further and look at the physical reality on the ground,
Yeah.
despite the strikes, despite the shipping volatility in the Strait of Hormuz, the core oil infrastructure remains largely untouched.
Really?
Yeah, the pipelines, the major extraction facilities, they're intact. If the Strait of Hormuz reopens quickly, or if diplomatic tensions suddenly cool, that geopolitical premium vanishes overnight.
Because the infrastructure is still there. If peace breaks out, the oil can flow tomorrow.
Exactly.
The prices would revert rapidly. The neutral underlying sentiment scores we occasionally see pop up suggest that without the immediate threat of military disruption, the market would reprice this asset down at a very, very quickly. You lose the sprint, and the contango escalator takes over.
Which perfectly maps out the final investment thesis and the target horizon here.
Yeah.
You cannot view USO as a long-term buy-and-hold portfolio cornerstone. It is strictly a swing trade.
Swing trade.
Yeah. The target horizon the market is looking at here is 1 to 3 months. It is designed purely to capitalize on the current volatility, the ongoing Hormuz escalation, and the immediate supply shocks.
It requires active management then. You have to utilize tight stop losses and really recognize that this specific type of volatility favors active traders, not passive holders.
Absolutely.
And the catalyst calendar over the next 3 months is packed. You have that monthly futures roll beginning each month, which artificially amplifies volatility amid these tensions. So you really have to monitor the NYMEX expirations closely.
Right. Let's bring all of this together. We are looking at an asset that offers a highly liquid first-mover advantage for anyone looking to play the surging crude prices driven by the Iran and Hormuz supply shocks.
Yep.
It has that tight near-month futures exposure, which avoids the worst of the tracking errors seen in competing laddered funds.
And the results really speak for themselves. I mean, it boasts top-ranked short-term returns, up over 25% in just 3 months. With an 8 out of 10 bullish score, clear institutional accumulation, and geopolitical catalysts that remain underpriced according to industry leaders, it's positioned for breakout gains as a prime target for a 1 to 3 month swing trade.
But there's one final macroeconomic element we need to factor in, zooming out from just the oil market. We know there are 20 basis points of Federal Reserve rate cuts already priced into the market for 2026.
Right, the Fed cuts.
If these massive oil supply shocks continue and energy prices stay elevated above $100 a barrel, inflation is going to rear its head again.
Oh, absolutely.
So this isn't just a commodity play anymore. Its appeal as a short-term inflation hedge is strengthening by the day.
The entire macroeconomic backdrop is shifting. You have a tightly wound supply spring with production sliding. You have unpriced geopolitical risks in the Strait of Hormuz. You've got the mechanical trap of the contango escalator, and now the sudden return of inflation fears tied to those 2026 Fed cuts. So considering all of that, how does a volatile macro environment change your portfolio's need for a short-term geopolitical shock absorber?